Hi there, I'm Melissa with Summit CFOs. Let me guess, your books get touched once a year at tax time and the other 11 months you're running blind. Or maybe you do get a profit and loss statement and it goes straight into a folder you never open. Or you scroll to the bottom, look at one number, and decide whether it was a good month or a bad one. Either way, you're flying without a gauge. Because that bottom number doesn't tell you why. It doesn't tell you which jobs made money, where the cash is leaking, or whether you're actually building a business or just buying yourself a job. And if nobody's putting this statement in front of you every month, that's the first thing that needs to change. By the end of this video, you'll be able to open your P&L and read the whole story in about 5 minutes, without an accounting degree. So let's go. First of all, what a P&L actually is. Let's forget the fancy name. A profit and loss statement answers one question. For this month, what came in, what went out, and what did I keep? It reads top to bottom in that exact order. Money in at the top, money out in the middle, what's left at the bottom. That's it. And yes, that's an oversimplification, but that's the gist. If you read a materials invoice, you can read this. The trick is knowing what each section is trying to tell you, so let's walk down it. So first of all, we have the top line, which is revenue. The number at the top tells you every dollar you invoiced or collected for the work you did. Re-roofs, repairs, service calls, all of it added up. One warning right here, revenue is not profit. I've watched a roofing contractor brag about a $200,000 month and still not make a payroll because he was looking at the top line and ignoring everything under it. Big top line, empty bank account. That's the most common trap in the trades. So let's keep reading. Job costs. The next section is your direct job costs, if your P&L is set up correctly. Some P&Ls call it cost of goods sold. Same thing. This is every dollar that only got spent because you did that job. Materials, field labor, dump fees, equipment rental, the subs you paid on that job. If the work created the cost, it lives here. This is the section that gets messed up the most. If your truck payment, your office rent, or your own salary is buried in here, your numbers are lying to you. Direct job costs or job costs only. Everything else goes lower. The next item is gross profit, which is the most important number that you're probably ignoring or is probably wrong because of misclassifications. Revenue minus job costs equals gross profit, and the percentage version, gross profit divided by revenue, is your gross margin. If there's one number on this page you should tattoo on your arm, it's this one. Let me make it real. Say you close a re-roof for $18,000. Materials, labor, dump, and subs come to $12,600. Your gross profit is $5,400. Divide that by the $18,000 and you get a 30% gross margin. That 30% is what's left to run the whole company. The office, the trucks, the marketing, and you. If your gross margin is sliding month over month, you're either underpricing your work or you're losing control of your job costs. Everything else on the page is downstream of this number. Next item, overhead. Basically the cost of keeping the lights on. Below gross profit comes overhead, sometimes called operating expenses. These are the costs you pay whether you run one job this month or 30. Rent, insurance, software, office staff, your truck payment, advertising. Here's how to read it fast. Overhead should be steady. If it's creeping up month after month while your revenue stays flat, there's a slow leak sinking your boat. Scan this section for anything that jumped and ask one question. Did that expense actually help me win or finish work? If you can't answer yes, then flag it. Next, we have the bottom line, which is net profit. Gross profit minus overhead equals net profit. This is the real bottom line. This is what the business actually kept after everything. Let me stack a full month so you see it below. Say you did $120,000 in revenue. Job costs $84,000, so gross profit is $36,000. That same 30% margin. Overhead ran $24,000. That leaves $12,000 in net profit, 10%. Now you're not guessing, you can see exactly where every dollar went on its way from the top of the page to the bottom. So let's talk about the 5-minute monthly check. Here's your actual 5-minute routine every time a P&L hits your inbox. 3 numbers, 3 questions. Number 1, gross margin. Is it holding steady or is it slipping? That's your pricing and your job costs. Number 2, overhead. Did anything jump that shouldn't have? That's your discipline. And number 3, net profit. Is there real money left and does it match what you saw in the bank? 5 minutes, 3 numbers. Do that every single month and you'll catch problems while they're still small enough to fix. The only thing that breaks all of this, none of this works if the statement is built wrong. If your job costs and your overhead are jumbled together, your gross margin is fiction and you'll decisions off a number that isn't real. That's the difference between a P&L that's just a tax document and one that's a decision-making tool. The categories have to be clean and they have to be consistent every month. When they are, the statement stops being paperwork and starts telling you how to run the business. Book a call and see how we can shore up your cash flow. While you're on the job site, we're on the books, making sure the numbers measure up. Have a beautiful day. No.